This is why AI companies will never live up to the hype. And it's not just that they're spending tens of billions of dollars. In some cases, they may even be lying to you. Hello, I'm Sam Putnam, and I'm so grateful that you're here. I'm the lead analyst of Stocks Community. And what I've uncovered in this investigation it's unprecedented. I mean, this is an absolute bombshell. I think it's probably the single most important work that I've ever done at Stocks Community. And it might be the most important work I've ever done in a decade of this business. I'm going to destroy a lot of lives in the investment community with what I've uncovered right here. And the thing is, nobody wants to talk about this. I mean, I've gotten all sorts of flack whenever I attempt to bring it up, whether it's on social media or with other investors. I mean, no wonder. The incentives for sweeping this under the rug are enormous. Trillions of dollars is at stake. And as you know, everyone in the investment business is getting their piece of the pie. The investment banks, the rating agencies, most investors, politicians, everyone is in on this. And of course, when that's the case, when there's a huge bubble underway, anyone who questions the theory or the hypothesis, they're going to stamp that guy out. And it gets way worse than that. If this plays out the way my evidence suggests, it could easily destabilize the entire US economy because its tendrils are intertwined with absolutely everything. And because nobody is willing to look at it or ask the most basic fundamental questions, I don't think anybody's prepared for what's about to hit the market. It might not happen this week, it might not happen this month, but the writing's on the wall there for anyone to see if they just look. And that's why we're here today, because what I've uncovered here is no question the single greatest threat to your brokerage account, your retirement savings, your way of life. This is the biggest threat to investors that I've ever seen in my entire career. And I'm not exaggerating when I say literally trillions of dollars of equity depend on one company and one man and one mostly false narrative. And my investigation has unearthed a lot of cracks in this narrative, all of which I want to lay out today for our subscribers in this video. What I've put together is shocking. I mean, it's remarkable, but what's really concerning is that I'm saying that even if most investors think their portfolio is de-risked and, balanced, even if they don't think their portfolio is connected to any of the companies that you're going to name today, they're still at a lot of risk. You see, unbeknownst to most investors, pretty much everyone has become over-levered to this one man, one company, and one narrative. And the reality is, if you own any stocks or bonds or ETFs, I believe you could be caught by the shrapnel when this whole narrative falls apart, because the truth is, this guy has built a house of cards and it's connected to almost every single part of our economy, and almost nobody's questioning the validity of any of it. But I found systematic risks here, and I believe when the fractures I've identified hit the mainstream, it could all come crashing down in one systemic blink of an eye. And that's exactly what my research shows. This could happen at any time. And I've been bold in calling this situation an Enron moment. I mean, that should get some people's attention. It's not just his firm's Enron moment, but I think this is an Enron moment for the entire US economy. And just so we're clear, this comparison to Enron, it's not something I make lightly. I really describe it using this analogy because it's the only way to explain what's really unfolding here, because even though there's no outright financial fraud that links, perfectly to Enron, at least not that I'm aware of, the parallels here are uncanny. And what I'm talking about is, opaque corporate structures, severe governance concerns. You've got convoluted financial deals, very questionable accounting practices, and these grandiose promises of future growth. Even the CEO reportedly has lied to his board of investors and is being sued by them. This is basically every red flag we saw during the Enron scandal. It's here. And I want to walk you through each and every striking connection. I think maybe the most important thing that you're going to show everyone is that there is a way to protect yourself from this threat. There's a trade that you would know very well that's designed to insure people's portfolio and could deliver returns as high as 2-to-1. So I think this is a great way to buy some insurance and to hedge your risk about this looming Enron moment. And I'm going to give everyone watching the exact ticker symbol, the exact trade, the rationale behind it, and of course, why I think it's a great move that every subscriber should make before it's too late. And I'll lay it all out because, like I said a moment ago in this live, what I've dug up could be the single greatest threat to your stock portfolio over the next, say, 6 to 12 months. Even Enron's former bankers have commented publicly on this stuff. I mean, this banker spotted the same red flags, and he uses an expletive. He says, you can't say I didn't warn you. Doesn't get more clear than that. I mean, people in finance don't normally talk that way, right? Jim Chanos, the famous short seller who made $500 million betting against Enron, he's warned of these similarities too. He said that we're in an era of rampant financial fraud. And you also have guys like Scott Galloway. He's the famous NYU business professor. He said that this one company could bring down the entire market. And I quote, "There's going to be nowhere to hide." What I found is really singular. And my goal today is to make sure you know exactly what's coming and how to prepare yourself in your portfolio for what I believe is going to be an Enron moment in the market. And when that happens, there's going to be millions of people who are blindsided, because I'm just telling you, if anybody knew what was in this report right now, the market would have already crashed. As I'm going to show you, though, there is a way that you can not only defray these risks, but actually potentially profit from them. And it's with one simple trade that I'm going to lay out in full detail for you today. This is a trade that, based on these concerns, could potentially return 100%, 200% or more. And that's without shorting any stocks, without attempting to time the exact Enron moment, and without stepping in any way, shape, or form far out on the risk curve. And this is the one trade that I think every subscriber needs to have in their portfolio. So when I started laying this out, the strategy, I was like thinking this is exactly what people need to do. So why am I giving this away? Well, with everything I've unearthed, it would actually be irresponsible not to give this away, because the downside here is really negligible, while the upside potential is remarkable, and that's an asymmetric way to protect yourself from what's going on here. The Enron moment that awaits. But before we get into that, before going public with this research, I had to be certain in all of my figures and analysis. I mean, there can't be a bit of doubt about what I'm saying. And I have some confidence in what I've done, because I know that I invested successfully through the crypto liquidation in October. And, sure, that was nothing compared to Enron, but it was a big shock out of the blue. So I just want to make sure you're on the same page with me that this is worthy of making the comparison to Enron, because that is a real big responsibility that we're taking. And I also know most people watching are probably too young to remember how devastating Enron was to investors. I mean, I studied it myself. I learned from a professor who studied long-term capital management, the fund that forced a $3 billion government bailout. And that same professor wrote a paper with the Secretary of Energy. So even if you just read the Wall Street Journal articles that really exposed it, in the entire 1 month process where it went from being worth billions to being bankrupt, I mean, it was absolutely brutal. And of course, as I know you know from history, Enron's collapse is what triggered the final down leg of the dot-com crash. The NASDAQ fell 30% further after Enron's bankruptcy. I'm not sure if you saw that, but Enron was at the time considered the greatest success story in corporate America. Enron, I know you've heard this, they were called the smartest guys in the room. And nearly every Wall Street bank had a buy rating on the stock. And the credit agencies, they all said that its bonds were investment grade. Fortune magazine named Enron the most innovative company in America year after year, including just a month before they collapsed. Everyone in the world was caught off guard. And worst of all, tens of thousands of retirees lost their life savings. So we want to proceed really cautiously here. I know that Enron is a subject that's deeply personal for most of our followers, and I understand this firsthand. I mean, I grew up in Vermont, and I was too young to know exactly what was going on, but I did see some of this firsthand in a different way. One of our neighbors, a friend of an acquaintance, actually worked in energy trading, and given the poor optics lingering from Enron in 2008, he almost lost his entire $100 million bonus during that Great Recession. The government had to bail out the bank that he worked at, and it was a financial tragedy for so many, and for him it was a strange tragedy at all. So I don't take this lightly. I feel like it's my duty to speak out, as nobody else really will. And like I said a minute ago, the incentives for staying quiet and to kind of keep the charade going, they're so powerful that nobody wants to say the obvious. And that's what's actually true. And that's exactly what we saw with Enron. Nobody wanted to talk about how convoluted their corporate structure was. Nobody wanted to talk about how they had earnings, but no cash flow. Why didn't anyone blow the whistle? Because everyone who should have had a giant piece of the Enron spend, the rating agencies, the common shareholders, the employees, the investment bankers, the Wall Street analysts, pretty much the whole world was making so much money off Enron that nobody wanted to pull the curtain back and see what the wizard actually was. And certainly no one's going to talk about it. There was just too much money to be made ignoring it. And we've got a very similar situation here. I mean, you can take it, everyone down from the president all the way down to retail investors, even, those with a few $1,000s in the market. They need this narrative to remain intact for this market to keep going like it is. And I feel like we have to speak out because the scale here is far larger than what we saw with Enron, FTX, or really anything else since the dot-com bubble. And at the peak of the dot-com bubble, Enron's market cap was around $70 billion just before it collapsed. We're talking about here's equity valuations in the trillions. The trillions. I mean, this is the heart of the entire economy. And the thing about it is almost all of today's leading technology companies are in one way or another complicit in this scandal. It's incredible. And I don't think I don't think it's going to shock a lot of people, but it could. And on top of that, the risks are extremely concentrated. See, the thing about Enron is it was primarily involved in the energy sector. And then you had FTX, which was cryptocurrency. But this one company that we're going to talk about that you have heard of is embedded itself across every corner of the modern economy. That's right. And if it stumbles, the shockwaves won't stay confined to one company or one sector. They're going to rip through the entire market. And as you'll see, I believe the structural underpinning of all of this is far weaker than anyone wants to admit. Okay. Listen, I don't expect you to just take my word for this. And we also know, unfortunately, that most of the people watching this will not be able to accept the facts that I'm going to show you. I mean, every other media outlet in the United States has been telling you the opposite of what you're about to learn here. And they've been telling you that, indoctrinating you for years. And I wouldn't have asked for you all to be here with me to go through my research if it wasn't really critical. So please, all I'm asking is that you just listen to what I've found, and then you can make up your own mind. Speaking of which, it's time to get into it because I believe this could all come to a head at any moment, even today while I'm filming this. And I'm urging subscribers to position themselves as soon as possible. And I want to get this investment recommendation to protect yourself into everyone's hands so that everybody can sleep easier at night, knowing that their downside is protected. And to understand what's unfolding here, we really need to go back and analyze what actually happened with Enron. And everyone watching will remember the crash, of course, but I've talked to lots of investors and really nobody, maybe 1 in 1,000, understand what actually happened to Enron. They don't understand how the fraud went on for so long. They can't imagine how the 7th largest company in the United States went to zero in about a month. And the reason why Enron lasted so long and was so devastating was because it had become entrenched with politicians on both sides of the aisle. It was giving money to the Clintons and the Bushes. How do you think they won the award for America's most innovative company 6 years in a row? As you know, including in 2001, which is the year they blew up. Exactly. In short, how did Enron pull the wool over the eyes of pretty much every investor, every analyst, every creditor, and every regulator? How did they do it? And the answer to that question is that they basically constructed this Byzantine maze of complex financial structures. You had special purpose entities, off-balance sheet arrangements, opaque corporate structures. And you had outright fraud as the CFO was stealing a bunch of money from the company using these, Star Wars named special purpose companies, SPVs, Jedi, and all those headlines. And I think a lot of people know about what we saw in the press around that time, but What's important is that the vehicles they used to achieve the fraud and covered up for so long, that's where the real story is, because my investigation has uncovered all sorts of crazy parallels. And this time around, what's happening in the tech industry, in particular with the AI industry. And I want to be careful here because although it's not exactly the same situation, and I'm not saying that these companies are committing fraud or that they will go bankrupt. But what I'm saying is that many of the same strategies that enabled Enron to engineer this illusion of growth for years are being used to prop up the AI narrative in the exact same way, driving earnings to extreme historic levels. And I was, very entertained in one way, but also really concerned because this is exactly what happened with Enron. And, I have to say also, I was skeptical when this whole situation was first coming to light as Enron 2.0. But when I see the details, the first thing that goes through my mind, it's all here. It's all happening exactly like it happened with Enron. So I'll walk you through the details of everything I've uncovered. But let's start at a high level and talk about the broader market first. So at Stocks Community, we've published a lot about the AI boom. And, we've covered the good and the bad. We've been very bullish on AI stocks for many years. And those recommendations have gone up significantly. Picks like NVIDIA and others that are in the ecosystem are making real profits, as well as smaller ones like Bloom Energy. So there's no doubt that there's an underlying technological revolution happening that's changing the world. And I think it's really important for people to understand we're not doubting the importance of the technology. This stuff, AI is like science fiction coming to life. But the big fly in the soup here is that there's no escaping that the companies in the sector are trading at very high valuations. And the key with that is that there's two ways you can have an inflated valuation. You could have a high price to earnings ratio where the price is inflated, or you could have the earnings being inflated. And if that's the case, the price might not seem extremely high, but if the earnings are inflated, that's just as high a risk that the things could collapse and that could come down. Just like the housing bubble, for example. And in the public markets, you have that situation going on. In the private markets, you do have a lot of companies with no product, no earnings, no real idea, just a group of employees raising billions of dollars. That's also true, and I've seen that many times in my startup career. Every time a truly transformative technology shows up, whether it was the railroads, the internet, cryptocurrency, pattern's always the same. Capital pours in on the promise of what might happen and usually ignores what's actually happening. Investor expectations, they outrun reality, and the narrative itself becomes the product. The only thing they're really selling is a story, and we're seeing all of those classic signs of over-exuberance right now. In the last quarter, the reports, 374 of the S&P had AI in their earnings calls, and of course, virtually none of those references were totally positive. There was no discussion in any of those calls about the downside risks or the execution risks, just constant name dropping about AI to get investors excited. And while they're mentioning it on earnings calls, the challenge is that the companies that are talking about all the AI initiatives, they're not seeing the real value accruing to the bottom line or even to revenue in a lot of cases. There was a stunning report from MIT recently. It's, one of the leading technology institutions in America. It showed that a staggering 95% of companies who have adopted AI are seeing no meaningful benefits as a result. Worse than that, another report found that 42% of businesses that had started these AI projects internally have basically scrapped them, and that's up from 17% last year. So we're actually seeing adoption go down, and I realize this isn't what a lot of people want to hear. And no one's going to be like, oh, this is good news. There's so much money being made on this AI trade in the markets. The people are getting rich, and pushing back against the AI hype isn't popular. But ignoring the data and what's happening in the real world is not going to change the end result. It's just like pretending your house isn't on fire. It doesn't help. So listen, when I first heard what this is all, unraveling, I thought to myself, sure, there's probably some possible fraud, and there's probably some absurd promotions going on in the fringes, the tiny companies that put out press release after press release making ridiculous claims about how their technology is going to be better than so-and-so's. But I was very, very skeptical that big tech's earnings are at risk. I mean, they're growing so rapidly. Microsoft's earnings are up almost 70% since ChatGPT was launched. And the capital investments they're making are obviously very real, hundreds of billions of dollars per year. I mean, as I sort of put together, yeah, I believe a lot of big tech's earnings are actually an illusion. And that's a stunning claim. But once you adjust for the financial engineering behind them, you realize that they're broadcasting a very different story than what the real economy is telling us. And folks, I do think this is the key to understanding the enormous risks that we're facing right now. So let's go to those facts immediately, because right now America is like a tale of two economies. It was the best of times, it was the worst of times. On the one hand, you've got absurdly high all-time record valuations in the stock market indexes. While on the other hand, we're seeing signs of severe distress, not minor, severe distress showing up in the consumer economy. We've seen big sell-offs in restaurants and e-commerce companies, clothing retailers, even casino operators. These earning reports that we're seeing across the rest of the economy outside of AI are absolutely screaming recession. Even the usually very safe recession-proof consumer staple industry was being hit. I mean, it's having a little rebound now, with software being down, but what stuck out to me was the CEO of Kraft Heinz, a staple company. It's stuff people eat, whether it's a boom or a bust. Ketchup, right? His comment was, "We have one of the worst consumer sentiments we've seen in decades." So people are really struggling right now. And when you see families pulling back on ketchup, mac and cheese, that's not a good sign. Not at all. And we're seeing it across the board. I mean, Gap, the clothing retailer, has reported that middle-income consumers are now trading down or deferring discretionary purchases. Another consumer staple company, it's ConAgra, said the same thing. They're seeing value-seeking behavior, which is another word for consumers, stretching their budgets. And to me, the two biggest warning signs are in what's called the Fed's Beige Book. And that reports that in areas of the United States, making up 80% of the population, that economic activity is already either flat or declining, which means this AI boom is only affecting a small group of Americans. And then secondly, what I think is an even bigger canary in the coal mine is that the credit markets are telling us the delinquency rate on subprime loans is approaching levels that were only seen in the 2008 financial crisis. And these default rates keep rising each month. This is a really, really dangerous omen, because subprime loans for things like cars, credit cards, buy now, pay later loans, these kind of credit, it's almost always extended to younger, lower income borrowers. And those are always the first people to suffer from economic slowdowns and rising unemployment. But these cracks are being papered over by record highs in the overall market indexes, all of which is fueled by the mania around AI. So at a cursory glance, it looks like the economy is doing well. GDP is growing. Stocks are up. But when you dig a little deeper, you can see a divergence since ChatGPT was launched. Sure, the S&P 500 is up 68% since then, but the overwhelming majority of those returns have been driven by the 165% rise from a handful of AI stocks. That's right. On the other hand, the average non-AI stock is up just 24% over the same period. I think NBC said it well. They said the S&P has turned into an AI index. Nearly half of the S&P 500's value, sitting at only 41 companies. Out of 500 companies, you've got 41 who are creating half the value. And what are all these companies involved in? They're all part of this new AI ecosystem boom. And it's important to understand just how unusual this is. I mean, we've never seen this level of concentration into a handful of the small stocks in one industry driving the entire stock market. And there's just no way that this ends well, especially when the real economy is suffering so badly. So if you take AI and the AI related stocks out of the equation, we're actually in a recession right now. The underlying real GDP growth in the US economy, outside of CapEx spending on these AI data centers and associated equipment, is actually down instead of reported numbers, showing GDP being up 3%. And the bottom 90% of Americans that don't have big stock portfolios, they're struggling. And the only thing supporting the illusion of economic growth is this massive hundreds of billions of dollars of capital flowing into data center infrastructure. And so we've got companies like Microsoft, Meta, Alphabet, Amazon. Those 4 companies alone will sink nearly $350 billion into CapEx this year. And that's an incredible increase, 10x over the last decade in their CapEx budget. And that's nothing compared to what's coming because they plan to increase spending to over $500 billion every year until 2030. And it's all well and good for them to project that, but the reality is these companies are running into a wall because all this CapEx has failed to deliver real cash flow returns. So what we're seeing in these companies is even though earnings are going up, as I mentioned earlier, the free cash flow is deteriorating at an alarming rate. And it doesn't look like that's going to change anytime soon. That's very Enronish. So the divergence between earnings and cash flow, that's when you start to see problems. And it kind of points to something unsustainable going on here. So despite all the obvious benefits that AI is going to bring to society, the technological revolution that it's going to usher in, and the wealth it's going to generate long term, it's not happening yet. And there's obviously a big risk that it might never happen, or it might take a lot longer than anyone expects to happen, which would also be catastrophic because the value of these data centers, in particular the chips that are inside them, they depreciate rapidly, far faster than other kinds of industrial equipment. So now we're starting to hit on the real root of one of the main problems here. If you look at recent reports, OpenAI is only estimated to be taking about $13 billion in revenue on an annual run rate basis. And if you look across all major AI applications in the economy today, the real revenue total across all these companies is expected to be about $30 billion this year. And it's only going to reach about $85 billion by 2029. And you might say, that math doesn't make any sense. You can't invest trillions of dollars and only generate $85 billion in revenue. And that's true. And what's the expression? The math doesn't math. It certainly doesn't square, right? I mean, these hyperscalers, the Microsofts, the Metas, and the Googles, they're on track to invest $500 billion annually to provide compute capacity for an industry that isn't going to crack $100 billion in revenue. What I mean, that doesn't make any sense. That's around a $2 trillion total investment to generate only $100 billion in revenue. I mean, a first-year finance student or math student can see the massive problem here. And here's the scary part. It gets worse. I mean, we're talking about revenue, but the real problem is the companies that are generating the lion's share of this revenue, they're losing billions of dollars in the process to their bottom line. So you take a look at a company like OpenAI, the 800-pound gorilla in the AI movement, owner of ChatGPT. They're a private company, so we don't get real clear details on their quarterly financials. But one thing we can do is we can indirectly infer how much money they lose through Microsoft, which owns a 27% stake in OpenAI. And we don't need to get in all the accounting intricacies here, but just as a quick high data point overview, in their most recent financial quarter, Microsoft recorded a $3.1 billion charge based on their 27% stake in OpenAI, okay? So what's that tell us? And again, this is ballpark, but we could infer that OpenAI lost around $11.5 billion in a single quarter, and that's an annual cash burn rate of $46 billion per year, okay? And if OpenAI's revenue is around $13 billion annually, and they're spending, close to $50 billion in losses a year, so that's like $3 to generate $3 of losses to generate every single dollar of revenue. And this cash, that's not a real business. That's an inferno. I mean, it's one of these things where you lose money in every sale and hope to make it up on volume. That doesn't work very well. I've never seen it work well. And this cash flow inferno shows no signs of stopping. Based on internal reports leaked to the press, OpenAI currently expects to burn an incredible $115 billion through 2029. I mean, the math does not square here. And it's the same with the number 2 company in the space, which is also privately held. They lost an estimated $5 billion last year, and they weren't even expected to begin generating profits until 2028. So, you've got the 2 largest companies losing billions and a handful of smaller ones that don't get a lot of press. We don't know where, their financial situation is with as much clarity. But the whole point here is that if the biggest companies in the space are losing billions, it's not much better for anyone else. And so we're not doubting the AI revolution. We're not doubting this technology, the capacity of it to change the world long term. But the simple fact is many of the companies that are leading this revolution do not generate anywhere near enough revenue to fund their existing business models. So, it's one thing for companies like Meta, Alphabet, Microsoft, they're throwing off tons of cash from their core, highly profitable business models. It's one thing for them to invest in this technology and lose money on it in the short term. That's not a terminal problem. They're not going bankrupt. The problem is the companies that are privately held, where this is their only business model. They're losing mountains and mountains of cash, and the math for them to make this work on a sustainable basis is daunting. So, as a case in point, there's a bad company that recently reported that the AI firms like OpenAI, Anthropic, that are the heart of this revolution, they need to find $2 trillion in new revenue by 2030 just to justify the CapEx spend. $2 trillion in revenue, guys. That's about 5 times the size of the entire global software subscription market today. And that's an industry that's been around for several decades. It's not an easy thing to do, and they need to find that amount of revenue in the next 4 years, which maybe, nothing's impossible. I mean, it could happen. Some new use case for AI could come along and unleash trillions of dollars in revenue. It could happen. But failing that, there's just no way for the industry to bring in enough money to support the trillions of dollars in capital flowing into data center infrastructure. And so here's the problem. In the absence of enough organic real revenue from the paying customers that are supporting this AI ecosystem, the players in the space have devised an alternative solution to keep the money machine going. And that, again, sounds a lot like Enron. It does. And it's this quote unquote creative solution to this financing risk that's creating systemic risk for the industry in the short term, and more importantly, for anyone with any exposure to the overall stock market in the long term. And that's exactly why I'm calling this AI's Enron moment. It's not really about any particular company. It's the Enron-esque financing that has built all of them. It's exactly the way that Enron engineered the illusion of revenue growth through an impenetrable maze of accounting tricks. These convoluted financial deals and ultimately fraud, which again, we're not necessarily claiming is at place here, but it's the same kind of opaque financing structure that inflated their numbers for years before the fraud was uncovered. I'm not claiming this is a fraud. I can just say it smells the same. It does. It smells awfully similar. And so here's kind of how this is. We'll talk about how this works in terms of the major players in the AI industry. What they've done is they've created an elaborate financial mirage to keep cash flow going into their businesses, keep their share prices rising, and to keep the bubble inflating. And, I talked about it already. There's all sorts of suspect things going on here. Not illegal, not fraudulent, just highly suspect. Again, not apples to apples comparison to what Enron did. Enron did engage in outright fraud, but they've also engaged in a lot of very questionable accounting, which a lot of it was actually legal. And what we found here are disturbing parallels in that questionable accounting and financing process that are creating severe structural fragilities and risks across the entire AI ecosystem. So it's basically a guide how to build a financial mirage and, not necessarily break the law, but certainly create a whole lot of risk. And the similarities that I've uncovered here are simply remarkable. And I'm going to go into all of them, but I know one of the things you're really worried about is, these circular financing deals that are absolutely Enron-esque. You've probably heard of them, and the best way to describe it is with an example. So let's look at the recent deal between 3 companies. You have OpenAI, owner of ChatGPT, NVIDIA, the chip seller to this whole ecosystem, and Oracle, which is building data centers that are filled with NVIDIA chips to provide the computing power. So OpenAI recently signed a deal to spend $300 billion, that's billion with a B, with Oracle on new data center infrastructure. That's like probably one of the biggest deals that have ever been signed in all of technology. It absolutely is. And so now we got to ask ourselves, wait a second, OpenAI is losing billions of dollars every quarter. So where does the money come from? The answer they received was at the same time that the deal was announced for OpenAI to spend $300 billion with Oracle, NVIDIA agreed to invest $100 billion into OpenAI. Where will OpenAI spend that money? And of course, they're going to spend that money with Oracle. Oracle is going to spend the money from OpenAI to buy NVIDIA chips And so you can see how the 100 billion from NVIDIA to OpenAI, OpenAI to Oracle, and then it goes from Oracle back to NVIDIA to buy the chips for the data center. It's a perfect circle. And we saw this so often during the dot-com boom when these startups had no money. The vendors, Cisco, Intel, they would invest in those businesses, and all those investments would go right back to further Cisco router sales or Oracle databases or networking equipment. Microsoft, it was all a big loop. And who ultimately got burned was the poor investor who was buying these dot-com startups. And in this case, it's just very clear. OpenAI is not breaking the law, but it's using wildly inflated stock valuation to get cash from NVIDIA. And then that cash in turn goes back to Oracle. And Oracle, of course, the cash finds its way back to NVIDIA. So, NVIDIA is not really losing anything, and they're selling a lot more chips. It's not hard to see why they do this, but it is easy to see how quickly this will break down if there's no real profits for OpenAI. And so where's OpenAI going to get the real revenues from real profits from actual customers? Hasn't happened yet, and it may never happen. And that's the problem. And meanwhile, the media keeps celebrating these deals because in the short term, all these big announcements are driving the stock prices higher of companies like NVIDIA and Oracle and everyone else who's involved in these similar kinds of deals. And they're happening with alarming frequency. You could say one or two might be okay, not a red flag, but here's the giant number at the heart of what makes this systemic is $1.4 trillion. So that's the amount of deals that OpenAI has signed and committed to spend over the next several years. And they don't have the money for it, just plain and simple. So here's the thing that gets interesting in this AI ecosystem. It's actually far more fragile than what's going on with the dot-com bubble because the entire circular financing scheme that's playing out across this whole industry rests on the shoulders of one single company. That's OpenAI. So if OpenAI stumbles in any way, if the narrative around Sam Altman shifts, if investors start to ask any questions, I believe he could risk bringing down the entire stock market. And the scale that he's operating on is just an entirely different universe of what we saw in the dot-com era with Enron or later with FTX. OpenAI is a private company, but at its last financing round, it was valued at $500 billion. It's incredible. It's the largest valuation ever for a private company in history. I mean, the scale of it, beyond being private or public, it's 7 times the size of Enron at Enron's peak. And it's not just the size of OpenAI here that's the problem. The real problem is that while almost all of Enron's financial chicanery was done internally or through these off-balance sheet special purpose entities, OpenAI has instead gone external. And what I mean by that is that these circular financing deals, they're linked to outside companies worth trillions of dollars. We're talking about Oracle, NVIDIA, Microsoft, Broadcom, AMD, Intel. You take it all together and you combine it, its equity value of more than $10 trillion, or 140 times the size of Enron. I mean, that's a major portion of the US economy. And so I believe that all this interconnectedness has turned OpenAI into a single point of failure for the AI market. And you have one stumble from this one company, it becomes every investor's problem. And until recently, nobody really seemed to question, this at all until, everyone's willing to ignore the fact. This is a company that's burning billions of dollars a year, but they somehow believe that it would make good on all these promises that it's made. And I would say that people haven't just been ignoring this single point of failure and the overwhelming likelihood that something bad is going to happen financially to OpenAI. People have been rewarded. I mean, look at how investors have made all this money because they've been correctly long so far on the big rallies in tech stocks. I mean, it was 4 separate days in the last few months. The stock prices of Oracle, NVIDIA, AMD, and Broadcom, they skyrocketed after they disclosed big OpenAI related deals. If you look at the total amount of money that was made on just those stocks, it's like $630 billion was added to their market value on the first day of trading after those announcements. I mean, this is a really significant bubble. We're seeing it play out with these massive stratospheric increases in valuations. And the thing to remember is it's all based on money just circulating through these same few companies. And the thing is, now people are starting to ask questions. And this is where it gets interesting. I don't know if you saw it, but months ago, Sam Altman was asked a real simple question, and I got chills. I mean, there's some striking parallels to things we've seen in the past, but the question, very simple question, uh, OpenAI, you have 1.4 trillion in spending commitments, and you're only making about 13 billion in revenue. I just want to make sure that the audience understands. This was on a conference call for investors. I mean, this was a podcast, and so this was in public, and the analyst was asking a very simple question, which is, you guys are being the recipients of $1 trillion in investment and loan commitments, and you're only making a couple billion in revenue. And how are you going to make good on all these investments? And that question just apparently set Sam Altman off, and he kind of went a little bonkers. He snapped. He went on the attack. And the thing to remember is the person asking this question was an actual investor in OpenAI. So, a friendly audience, Brad Gerstner. And so when you respond that way to a friendly question from one of your own investors, it definitely raises an alarm bell. And, the reason why it gave me chills was because one of the very last Enron earnings calls just before it blew up, an analyst asked why Enron couldn't produce a proper balance sheet on time. And instead of simply answering the question, he could have said, our accounting is very convoluted and it takes us longer. Skilling instead called the guy, a swear word in the middle of the call. What should have been a very simple question for any CEO to answer was, in hindsight, the clearest warning sign that all was not well at Enron. And it wasn't very long after that Skilling resigned and left the company, and it all began to unravel. So when I saw Altman's response to this, I thought immediately of Skilling and Enron and its exact parallel. And a lot of people felt the same way. And the very next day, SoftBank, the Japanese company that owns about 11% of OpenAI, it plunged by 10% on no other news. This was the catalyst for it. And it's now down 25% since that interview aired. And you see similar weaknesses in a lot of the companies in this AI ecosystem that are paired up with OpenAI. So Oracle was down 15%. Microsoft and NVIDIA both dropped between 5 and 10%. So I think this is going to go down as one of those emperor has no clothes moments in the AI narrative. And I just want to reiterate one more time, I'm not saying that artificial intelligence is not real or that it's not transformative. I mean, it really is an incredible technology. It's amazing. But it's just another reminder of a cycle that we've seen over and over again. Investors get out over their skis, they get swept up in the promises, and they stop asking the basic questions that let the hype blind out the hard data, like profitability, right? Simple things like that. And when that happens, people are willing to overlook some very serious warning signs in the AI ecosystem. And I think it's happening in OpenAI specifically. These circular financing deals are obviously the sort of epicenter of what's most concerning, but there's just a lot of red flags in this OpenAI story. And so a lot of them parallel exactly what went on at Enron. The most obvious one is just the corporate complexity. Enron built a maze of these things called SPEs, or special purpose entities. It was so dense that nobody on Wall Street could really pierce it, even understand from a high level what was really going on. And OpenAI structure is similarly convoluted. I think it's the most convoluted corporate structure I've ever seen in a half decade or more of being an investor. It's even more convoluted than Enron. So see if you can make any sense of this. The company has started as a nonprofit. Got that? Nonprofit. Pretty straightforward. They then built a capped profit arm to raise capital. Okay, I've never heard about that in my life. To bring in investor money, which they need because they're losing billions. They then restructured it into a for-profit public benefit company that is now controlled by that same nonprofit. What? I mean, I've never heard any of those things. It really makes no sense. And, that's the convoluted corporate structure that's just the tip of the iceberg. I mean, just imagine how much money they had to spend on lawyers to even invent this. The legal industry is making some good money off this, just like it did with Enron. And then, so it's complicated, but you get to these things, you see, when you get into a mania, which it brings out these grandiose visions of the future that are just detached from anything in reality that we're seeing on the ground with the technology today. And Altman insists that trillions of dollars are coming any day now. It's always just right around the corner. And that's exactly what Enron did. Every earnings call, the future got brighter. The promise is more dramatic. And so here's the thing. Maybe Sam Altman's right. Maybe all that wealth is coming. It's a technological revolution that changes the world. Maybe his spending commitments are justified, but what concerns me is his track record. His own board members and co-founders have accused him of everything from systematic concealing of facts to a consistent pattern of lying and not disclosing financial conflicts of interest, manipulating staff members' reports of psychological abuse. We don't know if any of these allegations are true or not, obviously, but it is being fought out in court. There's legal cases pending based on these allegations. And, it's just when an entire market depends on one man who's been described as a walking red flag, or what Elon calls him, scam Altman, These are things that give me a lot of cause for concern. I just want to say that. I just want to reiterate, I don't know the truth of any of these allegations, right? What I do know is that the AI board fired him for his dishonesty, and he found a way to come back and get control of it again. So there's just a lot of things that you never saw before. I mean, the Berkshire board never pushed Warren Buffett out and publicly called him a liar, right? You haven't seen Elon Musk go through that. You haven't seen, I'm just thinking about the best CEOs, Jamie Dimon at JP Morgan, Joe Gebbia at Airbnb, the Airbnb guys, the founder of Facebook, Zuckerberg, right? I mean, a lot of people don't like Zuck, and they say a lot of his behavior seems sometimes odd, but no one's ever accused him of these kinds of issues. So this is systemic, and you're seeing it from multiple parties, and it's not like they're just claiming these things, willy-nilly. They're filing lawsuits. So it's just a lot of red flags. And I'm not the only one that's seeing these fragilities either. One notable person that's kind of calling this AI bubble out is Michael Burry, who, as many of our YouTube subscribers know, he's the guy that made the killing shorting the housing market in 2008. And his claim is that companies like Oracle and Meta and other hyperscalers could be overstating earnings by as much as 20%. And the way that they're doing this, Burry claims, is by understating the depreciation cycle of their asset. So maybe this circular financing is a bigger deal, but I actually think that this depreciation schedule issue is going to be the pin that really destroys the investment returns that these companies are seeking. And I think it's really important that the audience understands that NVIDIA releases a whole new generation of their chips about every 12 months. And when a new chip is released, any company that wants to remain on the frontier of the AI revolution has to switch over to the new chip, or the performance of their data centers are going to be left behind. And ironically, this is one of the things that makes NVIDIA such an incredible company. They're the ones that are selling the shovels and the picks to those people that are mining for the digital gold in the AI space. And these tools need to be constantly replaced. Jensen Huang, the CEO of NVIDIA, joked about this issue after the release of their newest generation of chips. These are called Blackwell GPUs, and Jensen was saying that they couldn't even give away the previous generation, which was called Hoppers, because nobody wanted them. And you think about what that means in terms of depreciation. You're spending hundreds of billions on all these chips, and they have a shelf life of maybe 2 or 3 years. So how long is it going to be before all the big tech firms have to replace all of these chips? These development revolutions are happening every 18 to 24 months. But if you look at the hyperscalers accounting, they're predicting that these chipsets will stay economically useful for 6 years. And the same accounting trick has inflated the earnings across the entire AI ecosystem, probably by hundreds of billions of dollars. Amazon actually tested shortening the depreciation schedule by just 1 year, which I argue is still a pretty aggressive assumption, but that 1 year change triggered a $920 million hit in a single quarter. You start to do the math on the rest of the industry that's spending $200 billion a year annually on NVIDIA chips, and these chips could become economically worthless in as little as 2 to 3 years, but instead get written off over 5 to 6 years. We could be talking about a change in the accounting that wipes out anywhere from 150 to 200 billion in fake profits that are based on the wrong depreciation schedule. So you can have this earnings mirage that's currently being used to say, the big tech companies aren't crazy overvalued based on the PE multiple. But if the earnings are fake and they get reversed, they turn out to be extremely overvalued. Jim Chanos is another veteran short seller who's warned that the economic lifespan of these chips is 2 to 3 years, more realistically, not the 5 or 6 that most of the hyperscalers are using. And he says that most of the profits are materially overstated. If that turns out to be the truth, and I believe that these companies could be soon forced to make massive accounting impairments if we find out that these chip schedules need to be shortened. And so this could wipe out years of earnings in a single stroke, blindside investors who never realized that the numbers were inflated to begin with. So this is just one of those things that could force a violent revaluation of the major AI companies in this ecosystem. And in this depreciation mirage, it's exactly what put the pen in the dot-com bubble. I mean, historically, telecom equipment had a 50 to 30-year depreciation schedule, but the new tech-driven equipment that these startups were investing in, those things were obsolete in 3 to 7 years. And when you start to do that math, going from a 30-year depreciation schedule to a 7-year depreciation schedule, you immediately see the problem. There was maybe a 5-year window for these new telecom investments to pay off, but of course, they were all launching the exact same kind of services at very competitive prices, and there weren't any profits. So by 2002, the entire industry, not one or two companies, every single one of those startup telecom businesses went bankrupt. And I think this is exactly what's going to happen in the AI boom. NVIDIA's incredible pace of innovation is great for us. It's great for humanity. It's great for the customer, but it's terribly difficult on anyone who has to pay for them because the chip depreciation schedule is going to be much faster than anyone is willing to admit today. And that is exactly why I believe OpenAI and the other private AI firms are in so much trouble. It's also why you see them fighting so hard to keep this narrative intact. And as you've seen, I mean, they're doing all sorts of really suspect things just to keep this narrative going. And again, I'm not saying OpenAI is a fraud like Enron. It's not based on everything. I know, they do have real products. I mean, I use ChatGPT every day. They're leading the AI revolution, but they are just way out over their skis and they're doing everything in their power to keep the hype going. And the reason is because they know if investors stop to question the narrative for even one moment, this whole house of cards could collapse. And as one of the leading AI experts in the world, Pedro Dominguez puts it, Altman and Amidai is the CEO of Anthropic, which is the main competitor to OpenAI. Altman and Amidai are the most reckless AI hypesters because they have nothing to lose. Without the hype, their companies are already functionally bankrupt. That's coming from the expert in that industry, which is pretty alarming. And then, we're seeing cracks forming throughout this narrative. I mean, JP Morgan just estimated that to earn a 10% return on the capex we're currently spending on the AI build-out, companies like OpenAI would need to generate $650 billion in revenue by 2030 from about $13 billion right now. Sounds unlikely. I mean, you have XAI is doing around $3 billion, Anthropic, Claude's around $5 billion. So combined, this industry is still miles and miles away from $650 billion in annual revenue that's needed within the next 4 years. I'm not sure that our viewers here really understood what $650 billion annually means when you use these tools recreationally. It's very hard to get your head around a number that big. So I'm going to put this in context for everybody. $650 billion is the equivalent of every iPhone user in the entire world paying an extra $35 a month for AI. Or it's the same thing if you look at the Netflix subscriber base, it'd be like every Netflix subscriber paying an extra $180 a month forever. I mean, these numbers are so huge. I don't think anyone's ever really thought about what any of this means. And that gets to why our friends over at Zero Hedge recently put it, Sam Altman is begging for a bailout. And this is another one of those weird Enron connections. So maybe the audience doesn't remember, but when Enron was in fact collapsing, the chairman of the company, Ken Lay, called up his personal friend, George Bush, the president, and begged to be bailed out by the US government. And right now, we've seen OpenAI's CFO start laying the groundwork, that Altman really was trying to make noise about this AI boom being a national strategic asset. But fortunately, one of Trump's advisors shut that down immediately. He said there will be no federal bailout for AI. And I loved it because he says, look, it doesn't really matter if one AI company fails because someone else will take its place. So there's nothing strategic about OpenAI. But here's the key thing that Altman failed to mention. It's the subtext of this whole conversation. And it's that if one company that happens to fail, if it's OpenAI, well, the problem is that blows a hole, a $1.4 trillion hole into the future revenue of today's leading tech companies. These are the same companies that are pretty much propping up the entire US stock market and the economy. And that's why this is so important. That whole funding leading to earnings loop breaks down, and maybe these companies aren't worth anything like what we think they are. So just want to make sure, I have this clear. I mean, I believe there's a real strong possibility that the market's not come anywhere close to pricing these opportunities correctly. And the risks, really, all this earnings mirage that's being propped up by 1.4 trillion in future spending commitments are real. I mean, that's what all the future earnings estimates are largely based on. It's OpenAI spending. So if that breaks down, it's going to be a real disaster. And, when you put all this together, if you look at individually one or two of the risks here, whether it's the opaque corporate structure or the governance concerns, they could be shrugged off as one-off concerns and maybe not a big deal. But when you combine them all, and especially this $1.4 trillion funding circle that's at the heart of everything, I mean, it paints a pretty stark picture about the risks of OpenAI and Sam Altman in particular. And so the question is, will they go bankrupt? Oh, not necessarily. They could be backstopped somehow in some way or shape or form. But will the hype fail to live up to the promises, or will the reality fail to live up to the promises and the hype? And, that's where I think investors really need to be concerned about the risks here. And I'm not the only one that's starting to voice these concerns. There's people like Gavin Baker, the chief investment officer of an asset management company, recently put it, Sam Altman's manifestly ridiculous $1 trillion of spending commitments shifted the AI investing landscape. The market's more skeptical now, and, we're seeing more and more people voice these concerns that are money managers and that are putting money to work in this market. And this is a big problem because OpenAI is the sun that the AI cap spending spree rotates around. It's a good analogy. It's the center of the universe. And so through these trillions of dollars of circular financing arrangements, OpenAI has linked itself to the fate of really every major player in the ecosystem. And that includes America's largest tech companies. And as Andrew Bush, a top investment banker, recently warned, if Sam Altman stumbles on his financial circularity, the AI ecosystem fails hard. There's a lot of signs this is already happening, that OpenAI is stumbling right now. The most concerning one I heard was that ChatGPT, which is their leading AI product, it's been losing traffic over the past 12 months, apparently. And it's worse on their enterprise side, with their share of the API market being slashed in half as large companies have chosen to integrate with other AI models like Anthropic's Claude Code. And that's really the core problem here. It's kind of like the auto industry. There's a lot of people making cars. There's no real product differentiation. And so there's only going to be room for a very small number of winners, and there's no guarantee that they'll be OpenAI. So one of the things people will point to as a sort of moat around OpenAI's business is the fact that they've got so many users. I think it's 500 to 600 million weekly users. But like much of the OpenAI story, once you kind of open the veil and you dig a little deeper, you see a much different story. And one of the problems with this model is that most of their users are free. They're giving away the product. The estimated conversion from free to paid users is anywhere from around 3 to 5%. So, conversion rate like that would be fine for something like a YouTube or a Twitter and X. But for an LLM model like ChatGPT that's expensive and has to continuously buy the leading edge AI chips from NVIDIA, it's just unsustainable due to the extreme costs that are associated with providing this compute for literally hundreds of millions of users on the free version. There's just no scalability there because Every person that enters a query or signs up is just adding cost onto the business model. And so I believe this is all going to force OpenAI into a corner because with a conversion rate that low, revenue numbers that low, and compute costs so high, they have to rely on the narrative to keep the momentum of the investment dollars flowing into their business because that's the only way that they can sustain this business model that burns tens of billions of dollars in cash every year. The underlying economics just don't support what they build. And it's only a matter of time until investors wake up to the reality instead of the narrative. And when that happens, it's going to wipe out hundreds of billions, if not trillions of dollars off the valuations of all the major tech companies that are tied into the OpenAI ecosystem. I believe that this will also take the entire stock market down because everything's been over levered to these big tech companies. So that is the bad news, and it's bad. And I'm glad you've tuned in, and I hope you appreciate what I've done to bring this to light. I think it's at least somewhat brave. No one likes being the bearer of bad news, but I'm just bringing the bad news. I've got good news, though. I mean, the good news is I've figured out a way to protect against these risks and to not only insure your portfolio against a severe pullback, but potentially to profit from these developments. So this is just a simple hedging trade that I believe all of our viewers and really anyone who's invested in the overall stock market, which is most investors, can place this trade in their portfolio because without this type of insurance policy, the financial impact of what I'm talking about here could be severe. But before I get into that, the one thing I want to stress is that the key to this trade is not necessarily the upside potential. We're not looking to make a big windfall from this trade, although as we'll get into when I start talking about how this works, the profit potential on this trade could be significant, but I'm not too much focused on trying to make money from this trade. What I really care about is ensuring our portfolios against this type of unraveling in the AI boom that I've been talking about here. And so, as we've explored today, this unraveling looks more and more likely. And the thing about it is, I can't predict when it will happen, and exactly the timing is always hard with these things. But the key is, it doesn't really matter. The whole idea of having this insurance policy in your portfolio is that it's there when you need it, and it's going to pay off when the scenario that we've talked about happens. And that's why I want to give away this particular trade to all of our viewers for free. Excuse me, because I really believe it's nothing to sneeze at. It's a way to safeguard your portfolio from these very serious risks. And that's why I'm recommending to everyone the simple trade here. It's a small position in the SQQQ. Okay, so in layman's terms, buying the SQQQ is just a bet that the tech companies will decline at some point in the near future. Okay, and given everything I've talked about today, that does seem like a very serious risk and something that's very likely to happen sometime soon, right? And even if you remove everything I've discussed about OpenAI and the circular financing deals and the inflated earnings, this narrative that's starting to shift on the AI boom, if you ignore all that, I still think this is a very prudent move because if you just look at right now, the SQQQ is the inverse ETF. It tracks the opposite of the NASDAQ 100. So the valuation on that index is around 35 times price to free cash flow. And that's we've only seen the trade this rich before on one occasion. That was the last time that these stocks were this expensive was the peak of the dot-com bubble. And when tech stocks crashed in the early 2000s, this index, the QQQ, which is the NASDAQ top 100 stocks, it lost almost 80% of its value in like a year, and then it took 15 years to recover. And more recently, I'm sure you know, the NASDAQ traded for 35 times free cash flow just before the 2022 sell-off when the NASDAQ fell by 35% in like 6 weeks. And that was when investors began to question if these post-COVID valuations would be justified. And the great irony here is that the rebound since that bear market was not really caused by any change in the fundamentals outside of what's happened with this AI boom. The recent bull market since late 2022 has really been kicked off with the launch of OpenAI's ChatGPT in November of 2022. And there's just only so long that this party can continue based on all the risks that we've laid out today. So I think the wind could come out of the sails at any time, really. And what I've laid out, what I believe is going to happen is what I'm calling AI's Enron moment. And our goal with this trade is to protect ourselves before it's too late. And the thing is, we're not really worried about losing 5% of our portfolio, and a little correction here and there. That's not what this trade is about. What I'm trying to protect against is an outright market crash where you're talking about losses of 30, 40, 50%, the thing that can wipe out a portfolio and take years to recover from. Obviously, we're not rooting for this. I mean, I would much prefer that the bull market keeps going. I'm in the investment business, but hope is not a strategy, and we can't rely on that. So if this happens, and I believe certainly will at some point, you're going to see these kind of huge losses. And, what'll happen is it'll just get magnified and the downward momentum will accelerate. And eventually these big tech stocks that are all associated with the AI trade, eventually they'll be deeply undervalued, right? And then it'll be time to step back into the market. But how do we bridge this gap from where we are now, which is very risky territory, very overvalued, very likely to suffer a major crash? And then when the markets are all clear again, and the answer is we buy some insurance. So the short QQQ option that I'm talking about is like shorting the triple Qs. It's just an insurance policy. It's not actually an option. It's like when you buy car insurance, you hope that you never need it. But if you get into a multi-car pileup, you're going to be very happy that you have this policy. And with this kind of insurance that we're buying, it'll be the same thing. Even if the car gets destroyed, you'll be just fine. So I just want to reiterate, I don't want the AI narrative to pop. We don't want the markets to decline. We're not fools. We'd much rather everything kept working and appreciating, but I do believe there's a sincere, real likelihood that they're going to crash. And as you saw today, I think I've proven why it's very likely that they will. And when that happens, we want to make sure that not only is your downside protected, but potentially even you could profit from it too, right? And so that's why I'm encouraging everyone to put this type of, what I call portfolio assurance into place before it's too late. And, just to reiterate, my research is indicating that the best way to buy this insurance is just a long position on the inverse of the NASDAQ 100. It's a lot of Qs. It's the SQQQ. And by doing this, you're going to get an insurance contract in your portfolio. It's going to maybe make up, 2 to 5% of your capital. So we're not making a big Michael Burry style big short. And you don't have to worry about shorting at all because you're buying the inverse ETF. Excuse me. Plus, you're not buying some option instrument or doing something complicated like that. You're just buying ETF. This is not an aggressive bet on a collapse. It's just a small portion of the portfolio designed to insure against disaster that could wipe out years of investment returns. And so, on the one hand, if we're wrong, the nice thing about structuring the trade this way is you're only 2 to 5% positioned in SQQQ, so it's not a big deal. On the other hand, if we do see this true market sell-off that I think is a very high risk of happening, this trade could seriously balance your portfolio, potentially returning as high as 50% if these tech companies really unravel. And those are the kind of returns that I've seen people make from these kinds of insurance policies. And listen, of course, with trades like these, it's really important to make sure you're not putting your whole portfolio in this. Most importantly, you need to know when to buy this insurance, because if you buy when the market's already in free fall, you're going to miss the upside on this inverse ETF. It's like buying hurricane insurance after your house is blown out. There won't be any payoff really because you paid too much for the insurance. So I think it's really important that you get my expertise in this kind of insurance. And if you want those kind of recommendations along with my step-by-step guide to placing these important trades, everything you need is in this community that I've put together. And in just a moment, I'm going to tell you exactly how to get into this community on a trial basis. But I want to talk about the real magic behind these type of insurance trades. And I think we should share this with everyone. So I really care. I'm proud of the work that we've been doing for our actual subscribers in the community, in stocks community. These hedges can deliver huge returns and they can act as portfolio insurance. But what makes this approach so powerful is that it's a way to sidestep the impossible choice that most investors face in moments like this. And it's a choice that's humbled even the best in the world. Most people don't think about managing these types of high risk environments, but professionals do this all the time. And they usually choose one of two paths. Either they attempt to short the market, so their portfolio will go up when the market goes down, or they try to ride it to the top and then just get out, go to cash right before it crashes. And look at what happened with Julian Robertson and Stanley Druckenmiller. Now, these are two of the greatest investors in the history of the markets. Both of them knew and said publicly that the NASDAQ was in a bubble back in 2000. And both knew the bubble would pop soon, but they both wanted to profit from it. So they didn't just get out. They're looking for the best way to play it. And they actually disagreed. Julian Robertson thought shorting tech stocks was the way to go. Meanwhile, Druckenmiller, they call him the greatest of all time, he thought that riding the market to the very top and then just getting out was the way to do it. Well, guess what? Both of them lost billions. Julian was too early with his short selling and he got squeezed out right at the top of the market, shutting down his Tiger Management hedge fund in March of 2000. Right at the peak .com bubble within days. And, I did notice that Michael Burry just shut down his hedge fund too, right? So he might have gotten squeezed out as well. We don't know. But it's another eerily similar pattern to the .com bubble. Very similar patterns. Okay, but let's talk about Druckenmiller, because Druckenmiller, he understood the mania. He was very well aware it wouldn't last, but he thought it was going to go on just a little bit longer. So he actually bought $6 billion worth of tech stocks early in 2000, only to see those positions crash by 50% in only 6 weeks. So it's absolute disaster, wiped out years of profits. Okay, so I don't advocate trying to time the market in that way. I don't believe it's possible, but there is a third way, and that way is exactly what I'm doing for our subscribers. And that strategy allows us to not only ride the market up, but also ensures that we're protected and we can profit from its eventual crash. And this strategy allows us to safeguard our portfolio without attempting to time the top or the bottom of the market. And importantly, without shorting stocks and without taking on any excess risk at all. So this is a strategy that I learned from my first mentor in finance, who got the opportunity to work at a famous hedge fund. One of the great things about that is that, they understood how difficult it is to make these kind of trades like the Julian Robertsons and the Stan Druckenmillers. So they stripped it all out and they said, we don't do any fundamental analysis like Robertson or Druckenmiller. We don't try to predict the markets or anticipate trends. What we do is we build portfolios that are designed to weather any sort of economic or financial market event. And the trick with that strategy is something called a negative correlation, which all it means is you've got long positions, you've got short positions, and they don't all move in the same direction. It's not one big bet on one market outcome. And the goal here is to construct a portfolio where things move differently. So one part of your portfolio is rising in value, maybe the other part is underperforming, and then vice versa. And the key to that is by doing so, you can generate some remarkable results by the offsetting impact of those uncorrelated return streams. So the portfolio has low volatility. It's not that complicated, but it's good overall results. And it's really important because it's sort of risk-adjusted results are excellent. And, we're using the same kind of strategy, negative correlation. And we've been able to do something very special, something that most investors never achieve. It allows you to aggressively ride this bull market up without worrying too much about a crash or a pullback. That's arguably the most critical thing that any investor can do right now to protect and grow their wealth. It's time to hedge. It's time to lock in some of these gains. And so just an example of this, think about the start of this year. We were coming into, the enthusiasm post, holiday tax harvesting. A lot of investors were euphorically loading up on stocks as the market looked like it was going to make record highs again. In the stocks community, in our community, we were warning about the impacts of things like, the quantum euphoria and elevated tensions with China rare earths, and just the volatility that we're seeing out there with all the risks that we're building under the surface. So we were warning, community members about this. And our basic message, my basic message at the time was to, raise cash, have that dry powder, which is you don't have to have a hedging or active trading strategy in place. that's your default, but the hedging helps protect against risks in the market. And at the time, I didn't have any kind of trading method to show community members how they could hedge or even profit from downsides, like the trade that I'm talking about here. And the key, the way I talk about this internally in the community is it's sort of a way to generate crisis alpha, you could say. And so the beauty of having positions that pay off during a crash is that you can then cash in on those policies. And now you have all these stocks trading at dirt cheap prices that you can take that cash, you can go scoop up companies that you want to own for the long run. And that's where the real value is in these contracts, is getting that cash at the depths of a market crash when there's just a buyer's market for all the stocks that we all follow that we know are great businesses. And so that's kind of what I did in the beginning of September. And that allowed me to have one of, I would say, my best quarters ever as an analyst. When the market recovered, there was definitely a lot of 100% gains, stock community picks like Bloom Energy, D-Wave, Quantum, USA Rare Earths. And obviously I can't guarantee that I'm going to be able to deliver picks like that, on a quarterly basis. It was a very fortunate example of what happens when you have the right methods in place and how it can benefit you and your community members. But listen, the performance of those recommendations is not any proof of the success of, the community. They're different ideas that I had stated before formalizing the community. But the point of telling you about this performance is that I'm employing the exact same strategies in the stocks community as I did define those 100% winners. And this exceptional performance and the strategy behind it is why I'm very excited about launching this community in 2026. And you might be wondering, when did you start the stocks community? And the answer is my 33rd birthday, September 7th, 2025 is our official launch date. So we're about 6 months into it so far, but the feedback that I've gotten so far for the members is fantastic. And I'm sure if you check out stockscommunity.com, you can see some of these stories on the screen in the free training video on there. So I'm really proud of what I've accomplished, what the community's accomplished. And I'm actually most excited for what comes next, because as you know, it's during these periods like we're in just now that these type of strategies really shine. And once you have insurance in place, like we're doing with this inverse long position on QQQ or NASDAQ 100, really, it allows us to deploy the rest of our capital far more aggressively, which is exactly what we're doing inside the stocks community. So it's a brilliant strategy, if I don't say so myself. On the one hand, we know the AI revolution is real. It's not going away. And we're seeing hundreds of billions of dollars being deployed into it, soon trillions. Governments, corporations, and entire industries are going to have to reorganize themselves around this incredible technological revolution. But on the other hand, we see that all these kinds of revolutions, there's always a bubble and there's always excess. And that's exactly what we're seeing again today. We've got wildly inflated private company valuations. You've got all this stuff. We just see it in every single tech boom. Circular financing schemes, aggressive accounting, and earnings that only passes muster as long as nobody asks any hard questions about depreciation schedules. And this combination of all these things cooking for the last 3 years has created a really interesting setup for us. I mean, there's enormous long-term potential that's sitting on top of every, it's very real significant downside risk. There's a lot of them. And my job isn't to pick a side in some, AI good or AI bad debate. It's really to do two things. One, I'm trying to protect subscribers from a serious drawdown that could come if this narrative snaps and all the risks that, we've laid out materialize. But it's also to be always invested in the market safely and capitalizing on the overall bull market. And who knows how long this thing could run. There's a gargantuan amount of spending that's fueling this boom, and this melt up could last for who knows how long. If Stanley Druckenmiller or Julian Robertson couldn't predict it, like what chance do I have? And so the single best way to navigate these kind of environments is with the strategy that we've developed with the stocks community. And listen, it's simple, but it's not easy, but it is really simple, because what you're doing is you built a portfolio around different and negative correlations. You're not betting on one direction or one outcome. You're structuring a portfolio so that when you profit, no matter what happens, boom, bust, or stagnation, you should be okay. You should win too. And that's why in just a moment, I want to invite everyone here to join the stocks community, because although I've already been delivering some remarkable results, it's also true that we know the big opportunity, the collapse of this AI bubble lies ahead, and those results should be even larger. And if you've been watching the YouTube channel, this is one of the angles that I've been on lately, is that there's this under the radar area of the AI boom that I think offers really huge upside potential, almost regardless of how these AI companies at the center of things end up performing. And this is really the energy sector, because, no matter what the AI revolution is, whether it's here to stay, there will be CapEx. Maybe some companies get swept under the rug because they made commitments they can't fulfill, but this CapEx will happen. It's going to happen one way or the other. And the infrastructure and the chips that are being bought by the big tech companies, the one thing it all requires is a huge amount of energy. So when you look at every new data center that's being planned right now, and you add them all up, the projections, the US grid needs something like 80 gigawatts of new generating capacity. And just to put that in, circulation with the current production, it's impossible. It really is. So it's going to be impossible. And the thing is, the companies that are there to fulfill it, this impossible demand, they're going to have a windfall of earnings for many years. The amount of electricity, just to put that in perspective, 80 gigawatts, that's enough to power 40 million homes. And there's a few different ways. People are excited about nuclear, for example, but to make that amount of power, you need 80 nuclear reactors. They're about a gigawatt each. But we don't have the time to create 80 nuclear reactors over the next 4 or 5 years. It just takes too long to get these, get these plants up and running, permitted even, built, and the investment to line up behind it. So I think kind of all roads are leading to things like natural gas is a big winner for this trend. All the demand is going to be filled for the next decade by natural gas. Absolutely. And the interesting thing is, we've seen AI stocks go stratospheric on all different angles of this boom, whether it's utilities, chip providers, the cloud providers. But one area that it hasn't really touched is the energy market. And the market's just, for whatever reason, not priced in this huge amount of energy that's going to be needed to fuel this boom. And so that's why I'm starting to zero in on what I think is going to be the ultimate AI energy play. So I've got one company that I've got in the portfolio recommendations right now, which is a royalty company. This company in particular has one of the cheapest and deepest hydrocarbon reserves in the entire Permian Basin, which is one of the biggest oil and gas fields in the world. It's the most important energy basin probably in the world. And this is unlike some of the crazy valuations we're seeing in the rest of the market. This is a company that's trading at 19 times earnings. And those are earnings that are based on today's depressed oil and gas prices. Pays a 6% dividend. And, I just do not think the market has appreciated the fact that demand for natural gas is about to go vertical. What I like so much about this trade is it's sort of the opposite of the big tech stocks right now. Their earnings, I believe, are highly inflated and they're trading at very high multiples. So here you've got a company that's trading at a reasonable multiple with earnings that are depressed because the price hasn't skyrocketed yet for that commodity, but we know it will. And so this right here is exactly why I want you to join us inside the stocks community. What I've laid out today isn't some one-off anomaly. It's not just a speculative hunch. This is a massive trend that's going to redefine entire sectors of our economy for decades. And we want to position ourselves to capture that wealth creation at every step of the process. And most importantly, to do it without making a one-way bet to the upside or the downside. And if this AI narrative continues longer than I expect, I've got a whole portfolio of positions designed to profit from that. And on the other hand, if the narrative does collapse, this kind of hedge, our hedges, will pay off in a really big way. And it's just something that I think, a lot of investors, they're cautious about this market and they're looking for a conservative way to approach it. And I think that what we're doing with Stocks Community, what I'm doing, it gives people the ability to stay invested, to keep making money without the fear that there's going to be a collapse, because we've sort of got that safety net in place. And I think that's what's really important, is that we walk, every subscriber step by step exactly how to execute my trading strategy. So here's what I want to do next. At the link below, I put together a really good special invitation for you. This is a personal invitation for you to join my stocks community and to get access to my full daily recommendations. That's all the trades I'm picking, all the hedges that I'm using, the immense wealth of opportunities that I see ahead, and of course, everything else that you'll need to implement these strategies. Step-by-step instructions. And as you're going to see, my stocks community isn't like any other product here on YouTube or frankly anywhere else in our industry. It's unique because every single trade that I predict, comes from a live scanner that you can follow in real time. So there's complete and utter transparency. And more importantly, whenever I pick a trade, you know exactly how I selected it. And I mean that quite literally. When I launched the stocks community, I recorded all of the live trading sessions. So you can see how I pick the trade of the day. And so far, the results have been spectacular. Of course, as any trader knows, not all these trades are winners. There are losses, but my strategies ensure that I mitigate the downside risk. So overall, I've had a handful of 50% plus winning ideas virtually every month since I started. Both the results of the trades themselves and the feedback I've received from our members have been incredible. And the live aspect of this is just one of the things that makes this so unique. My strategy, it blends three elements that most investors never consider. It's the downside protection with the crisis hedges. It's the real-time scanners that find where money is rotating. And then it's also this other component that gives you significant upside potential through buying strong sectors and other trades that have uncapped upside, or asymmetric trades. So you can make, anywhere from 1, 2, 3, 4, 50% on some of these trades. And I'm not even talking about using options. With one of our trades in particular, we're up close to 300% right now. And it's not all about protecting the downside. We're aggressively looking for those upside situations when we can find them. And it's all operating inside one cohesive system. It lets us ride the bull market all the way up to the top while insulating ourselves from any kind of unwind or the sharp reversals that we see that could happen. And I want you to be a part of this. I'd love it for you to join us right now. And so I'm making it irresistible. My stocks community typically releases a majority of the trades at 9:35 a.m. So with our trading system, you don't have to sit at your computer every single day. Almost all of the trades go out, every morning between 9:30 a.m. and 9:45 a.m. This next trade that I'm going to make, all these new trades I'm going to make are going to be published before 9:40 a.m. So this new set of trades, it's really important, the set of ideas. And I'm building the scanner and theme identification around everything we've just covered. The emerging energy shortage, the distortion, tech valuation, the real underlying fragility in the entire AI ecosystem. And as a result, I've got a lot of great asymmetric opportunities. And in my view, the trades that we're targeting for February could be the best trades that we'll ever make. And that's how ripe the opportunity is now. And I want you to be positioned alongside me, ideally from the day I make, the next set of trades. And that's not all. I'm also adding something that I'm super excited about. It's a brand new stocks community channel, and it's going to allow our members to interact with each other, talk about the trades that they're making, share their own ideas, and much more. So that's something that I know has been missing from a lot of investing and trading products. And I'm thrilled that I'm finally able to give our users a community to participate in. It's going to really help people have a much better understanding of what we're doing. And of course, it's something that people have asked other communities to do for years. So I'm glad I'm finally doing it inside the stocks community. And so when you join, you'll be amongst the very first to get access to this new Discord. That's why for the next few days, I'm opening up some new spots inside the stocks community Discord and WAP. And even better, when you join now, you're going to come in on the exact same terms as our founding members did. So instead of paying the full retail standard price of $65 a week, you can try out the service for a full week of access for just $25. That's a 60% discount, $40 in savings. And once you're in the community, then that price will allow you to try out the service for 7 days at that heavy discount. So if you're ready to join us, just click that button below, that link below this video, and I've listed all the details for you there on that next page. Everything's laid out in very clear, simple terms, all your member benefits, your discount, the frequently asked questions that I receive, a full breakdown of my strategy in a completely free training video and bonus resources that you're going to get for free and much more. So you'll also get to see testimonials from existing members, and you'll learn why so many of them say this is the most valuable advisory that I've ever published at Stocks Community. It's all waiting for you on the next page. So go ahead, click the link below right now while this invitation is still on the table. But remember, after February 14th, this invitation is gone. Click the link down below to secure your spot inside the Stocks Community. Or if you prefer, you can always call me. I have a dedicated line I've set up just for you, just for the people who have attended today's YouTube live or are viewing the recording. So I'm waiting to answer any questions that you may have. And of course, if you want to join, I can get you started. So to get started, all you have to do though is click the link below. In the description, you'll get all the details and a full write-up of everything that I'm going to provide for you. You can head over to stockscommunity.com. And I just want to say thanks. I know that sitting down in front of this YouTube live or recording is not your favorite love of your life. You'd much rather be finding great investments in other YouTube videos, and I want you to get back to it on our videos tab. But thanks very much for sitting down with me and observing all the incredible things I've unearthed about the AI bubble. I just believe this is one of the most important moments that I've seen for individual investors in really years. And whether people join the community or not, I hope that today helps you understand the scale of what's unfolding out here, as well as the risks and the opportunities it creates. And so, of course, inside the stocks community, I can walk people through it step by step in real time with real scanners at work and hopefully generate some huge results for our members. I've got no doubt that's what we've seen so far. And this type of service is simply perfect for inflection moments like this in the market. You need to find a way to position yourself so that you can ride the bull, but also protect yourself from the growing risk of a massive market crash. And if you do that well, it's going to make a dramatic difference in people's financial futures. So, guys, ladies, please take a moment right now, click the link below, read everything on the next page, and I'm sure it will make sense for you. And I'd be thrilled to welcome you inside. So, thanks for joining me today.